Interest rates are increasing faster than any other time in the last 35 years. But yet economists are starting to predict when rates will go back the other direction. We'll share more in just a moment.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
The markets are still volatile. Interest rates continue to rise. Inflation is obviously an issue, and we have an immense amount to talk about here today. On the Trend Report, we will be going through data ending as of 10/21. That is data corresponding to last Friday weekend. And with that, let's first jump into interest rates. Interest rates themselves in the U.S. Have been increasing at a faster rate than any other time in recent history. Recent history being the last 35 years or so. And here you can see is the incline of the increase in interest rates taking place here under our current period of time. We have had interest rates go up higher. Here's 04 through 06. Here's 1988 through 1989. But we've not had them go up so rapidly as we've seen here. So it's almost like you can draw a line in the chart like this and look at it according to this area. So here on the left-hand side, we're looking at the interest rate increases, and along the bottom, we're looking at the amount of months that it took for us to get to that point. So in very short order, we have seen in just 6 months, the interest rates spike much faster than at any other point in time in current history. So the next question begs to be asked is, well, when does it turn back the other way? Well, the Wall Street Journal surveyed economists, and what they found is that about 60% of the economists believe that the Fed Reserve will start its next rate cut, not increase, next rate cut sometime in either 2023 Q4 or into 2024 Q1. Again, keeping in mind today that we're at 2022 Q4, so we're talking about a year or over from now is when the odds-on favorite are from economists for the Federal Reserve to actually turn back the other direction and potentially see an interest rate cut. So that being said, this is why you hear things about economists introducing or speculating that we are heading towards a recession. They do believe that more interest rate increases are going to be needed in order to put a slowdown and a stop and a retread against inflation to get us to start backing that inflation back down. So when things like this happen, when you have this kind of volatility, we've got all the things going on. We're coming out of the pandemic. We've got the interest rates increasing. We've got inflation. We still are dealing with supply chain issues. We're dealing with energy issues thanks to Russia invading Ukraine. There's just kind of one thing after another that's really kind of historic, if you will, that's been taking place. And when those things happen, that also jostles up what companies will continue to thrive, which ones will have to work to survive, which companies will come out of nowhere to become large corporate entities in the future. And that mix, that ranking of top companies, it changes much more rapidly than most people realize. So just to bring some perspective to that, I've added this visual for our discussions today. This is illustrating for us the 10 largest companies by market capitalization across the entire world in 5-year increments. Here we are in January 1st, 2007. Over here to the right, we go to January 1st of 2012, and then in the bottom left, 2017, and then finally January 1st of this year, 2022. So a few things jump out. You see Microsoft in here as the number 3 spot, and then they are down in the middle of the pack here on 2012, but then they are right back up to the number 3 spot again in 2017 and the number 2 spot in 2022. Microsoft is the only company that has been inside of the top 10 during this 15-year time frame, going from 2007, just before the financial crisis, to now 2022, just after the pandemic and potentially on the brink of a possible recession. Microsoft is the one that has had that staying power. If we look at the top three to kind of round that out, we've got ExxonMobil in the top slot for the first two periods there, 2007 and 2012. But then they dropped down to the number, what is that, the number five spot in 2017. And then they are off the chart in 2022. General Electric, kind of similar. Here we are in the number two spot. They are totally void. They're gone in 2012. They do resurface in the number 10 spot in 2017, but then again, they are gone in 2022. And you could go right down the list. Citi, this is the only time that Citi was in there. Toyota, I believe this is the only time that Toyota was in there. You see Walmart jump into the equation here in 2012, but then they disappear again after that. But then we see Meta, which is Facebook, as you probably know, jumps into the equation in 2017. Same can be said for Amazon and for Alphabet. Which is Google, is Alphabet. Actually, excuse me, Google did make it up here in 2012. But the point being, if you look at the listings here, you'll see there is a lot more movement in the top 10 largest companies than most people would expect. The other thing that's interesting is you'll notice, where are these companies from? And this is the grid on the right, tells you the color combinations. So here, we have, 5 companies in 2007 were from the United States in the top 10. Then we got ourselves up to 7 companies in 2012. In 2017, all 10 companies of the top 10 largest companies were U.S.-based companies. And now in 2012, we are at 8 companies are the top of the top 10 are from the United States. So again, just an interesting different way to look at, difficult with my words here, a different way to look at how times change and companies have to adapt, and those who do versus those who don't. With that being said, let's take a look at what's going on with capitalization. So each and every time we have this conversation, we talk about how we calculate our trending. Now, I've been tweaking this a little bit over the last number of discussions. I've been taking a lot of feedback, trying to make this as easy to understand as possible, because I know it's difficult when we don't have an immense amount of time to dive super deep into the numbers. So what I've done instead this time is we're looking at the macro and micro, just like we have in the past. We're ranking on the left-hand side by macro, on the right-hand side by micro. We're taking the macro using 10-day calculations in our formula. We're using the micro at a 1-day calculation in our formula. And then I've added this bull and bear column. So if both macro and micro are positive, we're calling that bull, a bullish indicator. If both are negative, we're calling that a bearish or bear indicator. And then we rank, and you can get some perspective from this. So the other thing we do is we take a look at the overall stock market right here in the number 10 spot on macro, and it does jump up to the number 6 spot on micro, because things have been starting to turn a little more favorable here in the short term. We do still have cash, the 1 to 3 month T-bill being representative of cash, coming in at the number 1 spot, and it is still showing bullish with both macro and micro being positive. When we come down the list here, we will also find our aggregate bonds. The overall bond market is bearish, and we are seeing that is becoming even more bearish, dropping all the way down to the 15th spot on a micro basis. And then down here we have international shares, or international stocks, I should say, the international stock market. That's jumping up just a little bit, but really basically about even. So on the macro side, we're looking at mid caps are kind of winning the day, whether it's growth, value, or the index in general, the overall index. But then over here on the micro, look what's happening. We're seeing the macro, or the mid cap 400 is down here for the index. Here's the growth. and here's the value. So what's starting to jump to the top are the large caps. We're seeing the S&P 500 value. We're seeing the S&P 100, which is the 100 largest companies. And then we do see the small cap getting up here as well, again, from the value side. So basically, it's value and larger cap, with the exception of value still being performing well in the short term with the small cap. But again, overall, we only have a bull categorization for cash, which basically means that it's outperforming the rest of the market. So when we look at the micros, we're seeing a fair amount of green over here on the far right, but on the macro basis, we're seeing all reds on all of the various equities. So then we jump into the sectors. And what happens on the sector is we see that energy, which we've talked about in the past, is the only one that's kind of continuing to lead the charge. It is showing up as bullish. It is positive on both the macro and the micro, right along with cash being in that number 2 spot across the board. We are also seeing a little bit more in terms of true bear in the sector arena as well. We've got utilities coming in as a bear, and we've got REITs or real estate coming in as a bear. You can see that over here on the far right in the micro, where they get grouped together when we're coming and going numeric by micro versus numeric by macro over here on the left. So healthcare is up a little bit higher. It has dropped quite a bit in the short term. Industrials are up here. They are holding, but energy is the sector that is kind of bucking the trend, whereas it is in positive territory on both our macro and micro calculations, and it is actually coming in ahead of cash. So when we start to see cash dropping down the list and equities coming up the list, that's when we truly know that the market is starting to turn back towards the positive.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.